Well, certainly our thoughts are with the people who are being negatively affected by this, but this will also affect the global economy. We've seen downgrades in growth and inflation across a number of our very large economies. In particular, in China, we've downgraded our 2020 growth estimate from 5.8% to 5.5%. So that certainly poses downside risk to our overall global economic GDP forecast, which is 2.7% right now. So certainly downside risk for that.
Liz Ann, as far as the market reaction, I mean, now we're building on a more than 3% rally in a matter of days, heading toward record highs. We're already there on the NASDAQ. So what does that tell you about where the market is at this point?
Well, I'm not sure it has everything to do with the coronavirus, obviously, with the number of infected going up by thousands every day. I don't think the market is rallying purely on some sense that this has been contained. Frankly, I think it probably has a lot to do with what had been driving the market for the past several months, which is liquidity from central banks. You've got some expectations that the Fed may have to step in if we see a bigger hit to global growth that starts to infect U.S. growth and possibly consider rate cuts this year, plus the stimulus that we've already seen announced by China and then more recently out of Japan. So I think it's back to that liquidity-driven momentum trade that frankly was a real part of the story before coronavirus.
Nothing Diana said just about the global economy and the outlook would reflect the NASDAQ at an all-time high and the other indices near an all-time high. So what are stocks saying right now?
Well, stocks are certainly rallying on other aspects. Certainly the U.S. economy is doing well. We just saw the...
But we just talking about a rate cut this year.
Well, certainly if you think of the Fed as kind of the global central bank, you do have that risk. But certainly last week we heard from Powell, and he said that the Fed is watching things. And certainly the Fed will be concerned if it feeds back, it's through trade channels or through financial markets in terms of the coronavirus effects on the U.S.
Does a rate cut make sense now, Liz Ann? We just got the services number. It was very strong at 55. I mean, a lot of the ADP, private sector jobs, an incredible number there. Factory orders yesterday. Do we really feel like we need a rate cut?
Oh, well, I'm not saying I think a rate cut makes sense here. I'm just saying that market expectations bumped up a bit when we started to get further details on coronavirus. And just the potential hope that we get a little bit more liquidity from the Fed, I think, has been enough to drive the market. Now, in terms of ISM or market, services would generally be not exempt from concerns with regard to coronavirus, but less affected by that. In terms of what we saw on the manufacturing side, which was a bump up, a lot of that predated concerns about coronavirus. Now, we had been expecting a stabilization in manufacturing, not least because global manufacturing had started to stabilize. And unique in this cycle has been the fact that, at least in the last couple of years, global manufacturing, global PMIs have led the U.S. both on the downside and on the upside. So a combination of the phase one trade deal and then stabilization in global manufacturing data, I think, was enough to lift the U.S. But we're not really seeing a lot of that survey data on the manufacturing side yet reflect the concerns about the global supply chain, CapEx plans as it relates to the virus.
So that's still a wild card. I guess what I was wondering, Dana, is the market getting ahead of itself too much, pricing in rate cuts from the Fed at this point?
Most likely, yes. I mean, certainly we're seeing that most of the effects have been contained to China in particular. Asia, again, we've seen some downgrades across our Asian economies. A little bit of an effect certainly in Europe via Germany, even Germany saying that some of the stimulus on their side can offset the negative effects from the coronavirus seen through trade, through travel, and also through supply chain. So unless we see a big outbreak here in the U.S. and unless we see the global economy really tank here, the Fed is probably going to remain on the sidelines in our view.
Diane, in terms of earnings, I mean, the thinking coming into earnings season was that January, the qualitative language would be better. You might take some numbers up as we got the halo effect around phase one. Clearly, the virus has postponed that to a degree. But do you think numbers go up or down from here for the year?
Liz Ann.
Oh, sorry.
Liz Ann, sorry.
Estimates for 2020 are still, mid-single digits for the first half of the year, back up into double digits for the second half of the year. I think there are still a lot of wild cards, not least being what we've been talking about for the last few minutes, which is coronavirus. And remember, China's impact on the global economy and the U.S. economy is certainly much elevated relative to where we were back in 2003. And part of China's efforts to sort of morph their economy has meant that their consumer is much more dominant, which does have a greater impact on many U.S. companies, some of the biggies that have already announced suspension of business there. I also think the profit margin story is not being reported significantly, and that's largely a function of tariffs. And even though some of them were pulled back, the September tariffs, we didn't get the December tariffs, most of them are still in place. And I think companies are still digesting how to absorb those tariffs, whether to do it in profit margins or attempt to pass it on to the consumer. So I think it's more the profit margin story that should be a focus in 2020 than just the bottom line numbers.
Which sectors are you in? Liz Ann.
So we have only two overweights right now, which are healthcare, which has been a longer standing overweight, and then more recently financials. Most of the rest are in the neutral to slight underweight. So that's we within those neutral categories, we do like tech. Keeping it at neutral or market weight is just reflecting some of the valuation excess in some of the pockets of tech.